I think today's moves you can largely attribute to those factors, but I think if you look beyond one day, there are good reasons to be more bullish and more cyclically positioned, and it goes to how most of the market is positioned. I think everyone's worried about a recession. Everyone's worried about some of the geopolitical events, particularly trade. And people are very defensively positioned. They're hiding out in treasury bonds. They're hiding out in yield-oriented stocks. And although it seems counterintuitive when the market's near all-time highs, I actually want to be pro-cyclically positioned because I think that's where the value in the market is. So I think it's 50-50 on whether the market goes up or down from here. But I think there's a much bigger payoff to betting pro-cyclically than there is from hunkering down and staying defensive. I know Rich disagrees with that. I look forward to hearing what he has to say.
Yeah, I mean, Rich, what are your thoughts? And is the political risk one that the markets have not yet priced in, especially as, you know, the odds of the House passing some sort of impeachment movement, I mean, that's now at 42% according to Predicted. So it's basically doubled over the past couple of weeks or so. Is this the risk that the market has not put in at all? And it doesn't have to be that you believe that the president will be impeached, but it could just be that you believe that President Trump enters the 2020 election cycle in a more weakened state.
Right. So, Melissa, there's a lot packed into what you just said. But I think the important part is that we've seen ridiculous events occur for the past 2.5 or 3 years. I mean, one day up, one day down, everything else. The market for most of that period went up. And so now the question is, why is the market now very shaky when we're getting more of the same? What's changed? And the answer, I would argue, is the fundamentals in the background are weakening. And so when the fundamentals are strong, the market can shrug off a lot of these events. When the fundamentals are weakening, it can't. And there's no counterbalance to the issues that are going on in Washington. So I think that's what people are missing, is in the background, fundamentals are weakening. They're not weak in an absolute sense, but they are weakening, and our expectation is they're going to continue to weaken.
Richard, though, that's a source of much debate. I mean, you have the city's economic surprise index went back up to recent highs. You know, we know well that the manufacturing stuff is looking worse than the consumer side. So there's plenty of people who are just taking the other side of that point of view and saying they don't think things are slowing down. I'm just wondering, because your point of view is to stay defensive, if you're concerned about valuations there, about how crowded some of those trades have gotten this year.
So at this point of the cycle, I think it's important to understand that defensives always look expensive at this point in the cycle because cyclical earnings have been robust and cyclical PEs have contracted. Therefore, the rest of the market looks very expensive. My very first boss on Wall Street said you never buy cyclicals at 9 times earnings. You buy cyclicals at 90 times earnings because that meant that their earnings were depressed. It was the trough of the cycle, and you were about to get huge earnings growth in cyclicals. But when you see cyclicals at very low multiples, it signals you're at the peak of the cycle. And I think that's what we're seeing right now. And the relative valuation of defensives is not that different from what you would see in any late cycle environment, I would argue.
Eddie, how would you counter those arguments?
Well, I do think that's the key question is not just what's the economic backdrop, but what is priced into securities. And I agree with Rich's point that deep cyclicals, you want to buy them when they look expensive because you want to buy them on trough earnings. But many of these companies have already seen significant earnings downgrade. So I'm not sure they're trading on peak earnings. And even if you look at them on earnings-based metrics, they look considerably cheaper versus the defensive stocks, but in particular versus the secular growth stocks. You have some sort of steady growth companies that you find in the better retail companies, for example, some of the consumer staples that have some growth that trade at 28, 29, 30 times earnings. You have some utility stocks that have growth trading at 26 times earnings, and yet you have banks. I'll take banks as an example. I don't think they're over-earning by a significant margin. They're trading at 11 or 12 times earnings for some of the larger banks. So when you have a 2.5, 3-to-1 spread on the valuation, I think it pays to bet pro-cyclically, even if the narrative on the economy is not particularly rosy at the current moment.
All right.